What if I told you that China created a shadow banking system larger than the entire US banking system in less than a decade? And what if I told you that this system, which financed ghost cities, funded speculative real estate projects, and accumulated mountains of debt, somehow hasn't triggered the financial crisis that everyone keeps predicting? Let me show you the dark side of China's financial system. It's a world of wealth management products, local government financing vehicles, trust companies, and Chengdu bonds. It's a world where forbidden fruit was ostentatiously consumed, where back channels opened investment in previously off-limit sectors, where financial experts bilked naive investors with promises of exorbitant returns. This is shadow banking, Chinese style. And understanding how it works and why it hasn't collapsed is key to understanding China's entire economic system. The story begins in September 2008 in Shanxi province. President Hu Jintao, his policy advisors, and several Politburo members were considering how to manage the devastating aftershock from the US financial crisis. Their conclusion: China needed to undertake massive fiscal spending. If they didn't roll out the largest stimulus package imaginable, China might suffer a lost decade like Japan. 2 months later, Premier Wen Jiabao announced a fiscal stimulus package of RMB 4 trillion intended to boost the economy. It was a fiscal splurge, RMB 1.5 trillion to railways, roads, airports, and power grids, RMB 1 trillion to post-disaster reconstruction, RMB 1.14 trillion to housing and rural livelihoods, another RMB 0.36 trillion to environmental protection and education. Internationally, China earned praise for the speed and scale of its response. But the big question was who was going to provide the money and implement the projects. The central government was unprepared to take on the budget deficits needed to finance such massive spending. The solution was brilliant and dangerous. The central government instructed local governments to carry out the spending. But there was a problem. A 1994 budget law prohibited local governments from running deficits or issuing bonds. So how could local governments borrow the money they needed? Enter local government financing vehicles, or LGFVs. These were companies nominally independent from local governments but actually controlled by them. They could borrow from banks and issue bonds. It was a legal fiction, but it worked. In 2009, there were only 3,800 LGFVs. By 2013, the number had nearly doubled to 7,170. The total debt borne by these vehicles rose from RMB 6 trillion in 2009 to an estimated RMB 45 trillion 6 years later. In recent years, LGFVs funded megaprojects like the $2.4 billion Shanghai Tower, the second tallest building in the world. The central bank endorsed the practice at first. On one end, the Ministry of Finance encouraged local governments to use LGFVs to borrow. On the other, the banking regulator encouraged state banks to lend generously to them. Of the RMB 4.7 trillion in new bank loans extended in 2009, half went to LGFVs. In normal years, new bank loans constituted 15% of GDP. In 2009, that number shot up to 27.5%. But here's where things get interesting. This massive lending couldn't stay on bank balance sheets forever. Banks needed ways to circumvent regulations, to lend more without appearing to lend more. And that's where shadow banking came in. Starting in 2005, Chinese banks began selling customers new savings instruments called wealth management products, or WMPs. These were like term deposits with an average maturity of a few months, but they weren't subject to capped interest rates. More important, banks no longer needed to guarantee the principal, allowing them to move WMPs off their balance sheets. In the years following 2009, the total amount of WMPs outstanding took off. From less than 2.6% of GDP in 2008, these products grew to 40% of GDP in 2016. In 2013 alone, RMB 3.1 trillion worth of WMPs were sold. By the end of 2017, unguaranteed WMPs stood at RMB 22.2 trillion, or $3.36 trillion. Banks funneled the proceeds into outside trust companies, which subsequently invested the funds in bonds, credit instruments, or directly into specific companies or projects. The crucial difference: unlike banks, trust companies weren't subject to regulatory oversight. Free from loan restrictions or capital requirements, they became off-balance sheet vehicles for banks. Areas that had been off-limits to investment were now wide open. Trust companies controlled by banks or central SOEs pumped money into real estate, mining companies, and local government financing platforms. Between 2010 and 2015, trust company assets surged from 6% to 24% of GDP. Commercial banks weren't the only ones playing this game. Enterprises of all kinds saw in shadow banking an opportunity to make big profits. Through shadow banking, anyone with privileged access to official financing could borrow money cheaply and lend it at high interest rates. These so-called entrusted loans, essentially firm-to-firm loans, became a major component of shadow banking. Local governments fully embraced shadow banking. They began issuing urban construction and investment bonds known as Chengdu bonds. These were considered corporate bonds, but everyone understood they were implicitly guaranteed by local governments. The number of new bonds issued climbed from 79 in 2008 to 1,104 by 2014, an astonishing growth rate of 85% each year. By 2014, RMB 4.95 trillion was outstanding in Chengdu bonds. The share of bank loans in local government financing had dropped from 80% to less than 20%. Shadow banking had completely taken over. Over the 6 years following 2008, the size of the Chinese economy doubled from $4.5 trillion to $9 trillion by 2014. However, total Chinese debt rose to more than 230% of GDP. A significant portion was channeled through shadow banking. Now, you might be thinking, this sounds exactly like what caused the 2008 US financial crisis. Banks circumventing regulations, raising short-term financing for risky investments, accumulating massive debts. So why hasn't China's financial system collapsed? The answer reveals something fundamental about how China works. The structure of shadow banking in China is actually much simpler than in the US. In the US, shadow banking revolved around complex forms of securitization, carving up tranches of loans and repackaging them into securities. There were 7 intermediary steps, a long, complex, opaque chain. In China, things are simpler. Banks collect money from retail and corporate investors by offering high-return WMPs and trust products. There are just 1 or 2 intermediary steps and mostly plain vanilla loans. No long, complex chains of interconnection. But that's not the main reason China has avoided crisis. The real reason is state capacity. Former Treasury Secretary Tim Geithner said that every financial crisis is a crisis of confidence. When people lose faith that their money is safe, they flee. When the U.S. lent a helping hand to Bear Stearns, the market calmed. When it refused to bail out Lehman Brothers, the bottom fell out. In China, politics won't get in the way of saving the financial system. The state not only regulates the banks, but also owns them. Banks own the debt of local governments. This means it's unlikely that a major bank will be allowed to fail the way Lehman was. China's state capacity extends far beyond backstopping banks. During the U.S. financial crisis, a severe credit crunch froze the system. If the U.S. government had injected liquidity, the spasm could have been averted. But Congress wasn't interested in further bailouts. In China, the government would simply order the banks to make more money available. The most alarming aspect is pervasive debt. The overall debt-to-GDP ratio in China reached a record high of 275% in 2022, making it one of the highest in the world. But debt crises occur when borrower and lender cannot agree to resolution. And when lenders don't act in a coordinated way, in China, most debt is owned directly or indirectly by local governments or state-owned companies. State control of both borrowing and lending makes default resolution much simpler. If necessary, the central government can step in and resolve things. This doesn't mean shadow banking is benign. The potential for disaster is vast. WMPs alone amounted to about 35% of China's GDP at its peak, 4 times the value of Citigroup, Bank of America, Wells Fargo, and JP Morgan combined as a share of US GDP. The weakness is the potential for a run on WMPs and trust products should investors suddenly lose their appetite for risk. Panic is contagious and could lead to waves of default. Evergrande, the fallen property giant, counted 40% of its financing from trust companies before it became embattled. When it defaulted, it triggered a cascade of losses. But to cast shadow banking in only a negative light would be an injustice. It served as a remedy, however flawed, for glaring deficiencies in the traditional financial sector. Principally, it filled a void when it came to pervasive credit shortage. Small and medium-sized private companies without access to formal channels found relatively cheap capital. Households found higher returns on their savings, albeit with greater hidden risk. Shadow banking also accelerated development of the corporate bond market. Today, China's corporate bond market is the 3rd largest in the world. So here's the paradox. China created a shadow banking system that by all rights should have triggered a massive financial crisis. It accumulated debt to GDP ratios that would terrify any economist. It financed speculative real estate projects, ghost cities, and inefficient infrastructure. It allowed local governments to borrow trillions off balance sheet, and yet no crisis has occurred. Every decade brings a new cause for concern. In the 1990s, non-performing loans. In the 2000s, the property bubble. In the 2010s, shadow banking debt. In 2001, Gordon Chang's The Coming Collapse of China predicted the end within 5 to 10 years. The Economist ran articles titled The Great Fall of China. None of these predictions came to pass. Why? Because China's financial system operates under fundamentally different rules than market-based systems. The state's ability to mobilize resources, order banks to lend, backstop failing institutions, and resolve debt disputes gives it tools that Western governments simply don't have. This doesn't mean China can avoid crisis forever. The debt pile keeps growing, the property market is cooling, local governments are stretched thin. Shadow banking may have been reined in somewhat, but the underlying problems remain. A financial system that channels too much credit to inefficient state enterprises, a real estate sector that accounts for 30% of GDP, local governments dependent on land sales revenue. But understanding why China hasn't had a crisis yet is key to understanding its entire economic model. It's a model where the state's capacity to intervene, to order, to mobilize can overcome what in market economies would be fatal flaws. It's a model where political will can, at least for a time, substitute for market discipline. The question isn't whether China's financial system is stable. It clearly isn't. The question is whether the state's capacity to manage instability can continue to prevent crisis from erupting. So far, the answer has been yes. But as debt keeps mounting, as the property sector struggles, as the easy growth of catch-up development fades, that capacity will be tested like never before. The 20 trillion housing bomb, the shadow banking explosion, the debt pile, they're all part of one interconnected system held together by state capacity and political will. And that system is approaching its limits.